Well, the story of South Africa's economy and the slight improvement in activity continues to capture headlines today, with the Business Confidence Index by Rand Merchant Bank regaining some ground in the third quarter. According to the latest data, sentiment is still very weak among business leaders, with many pointing to the high interest rates, the resultant strain on consumers, and social unrest as some of the major concerns. For more on this, we're joined by Siobhan Redford, who is a macroeconomist at Rand Merchant Bank. Siobhan, thank you very much for your time. We just heard another story just a few minutes ago about the Purchasing Managers Index, which means that the factory floors, those who run our factory floors, are actually doing well. When it comes to the latest survey, that is this current survey of the business confidence, it covered 1,050 senior executives in the building, manufacturing, retail, wholesale, and the motor sectors. Why has sentiment, do you think, or do they say, among business leaders improved so much in quarter three?
So I think it's important to bear in mind, so we are going to talk about an improvement, and we are happy about that. But, you know, at 33 index points, it's also worth remembering that 1 out of 3 business executives are satisfied with business conditions, which means that a majority still remain unsatisfied with these conditions. What led to this improvement? Well, very likely the fact that we didn't see as bad load shedding as had been expected, you know, kind of during the winter months, which did make doing business a little bit easier. Also, you know, resilience in the face of the load shedding that we did see, and lower inflation, as well as the likelihood that we have reached the peak of our interest rate hiking cycle.
Siobhan, the story of business confidence, particularly for this quarter we're talking about, is sort of similar to the GDP data that we saw yesterday coming out for quarter two, that although there was an expansion, but it's still only a mere 0.6%. But it would be a different story if it had fallen. It's not enough, but is there something to take away from such indices and such economic data to tell us that things are going to get better, particularly for the ordinary man on the street?
I think it doesn't really tell us that it's necessarily going to get better as yet. I think it does indicate some level of resilience. That said, it is worth bearing in mind the way we think about it is that we are seeing, you know, for example, in yesterday's print, that gross fixed capital formation is doing quite well. However, it's got a very narrow focus, being power mitigation or infrastructure shortfall mitigation. And while that's the case, the problem is that actually what's happening is that funds are being directed towards that rather than expanding potential operations, as well, which means limiting the amount by which employment can improve. So it's not really a really good story because, you know, while these issues continue to plague businesses in the economy, it's really going to be about staying open and keeping the doors open than it is about expanding at any rapid rate.
Let's go back to this BCI. The biggest fall in the sentiment among business leaders in the last quarter was among the consumer-facing sectors. That should not be a surprise for new vehicle sales, dealers and retailers. There is no money when it comes to consumers. There's no disposable income, as it were. This is not a surprise at all.
Absolutely, you know, and as you say, and we saw it again in the GDP number with household consumption expenditure contracting in the second quarter. You know, even though we have seen inflation come down, and you know, at least by July it had actually come to within the inflation target. Within that, you know, we've got to remember you're still seeing very high inflation for food, which is a necessity, which is kind of taking away space. It's crowding out other potential expenditure. We know petrol prices are incredibly high. That's also doing crowding out. And then to add to it, July, August, we see our municipal rates and taxes increase. So definitely from an inflation point of view, quite a bit of crowding out by some kind of sectors versus others. You know, even though we have seen the peak of the interest rate cycle, or we think we have, you still have very high interest rates. And so that means anybody with debt is paying a much higher interest kind of payment on a monthly basis than they were even a year ago and 2 years ago. So that's also, kind of crowding out potential expenditure. So the environment isn't strong, and it isn't completely favorable. But that said, the fact that we probably are at the peak and the fact that inflation is moderating is probably what gave those consumer-facing sectors a little bit of hope, especially given that they had fallen so much in the second quarter.
Siobhan, when it comes to this data, we're looking at confidence among another major sector, which is the retail sector, also slightly improving. Although sales were weak, profitability improved on the back of those softer purchasing price increases. Let's talk about the next couple of months until the end of the year. This data came in before the height that we're experiencing now, that we started just a couple of days ago of stage 6 load shedding. If this remains for the rest of the year, paint us a picture of what could happen to our economic growth forecasts and this particular improvement that we've seen in business confidence that has inched higher. What could happen for the rest of the year?
If we continue to see stage 6 load shedding like we've seen now and is being kind of suggested, it does not bode well for confidence or activity for the rest of the year. It does seem that once we kind of reach a threshold of load shedding, say above stage 3, that the impact on business operations, the ability to do business, are much worse. That said, we do know that some businesses, manufacturing in the retail sector, and more broadly, have invested in some kind of mitigation for load shedding, and perhaps that will allow resilience to continue even as we see these higher rates of load shedding, particularly now that we have entered the summer months, which means more sunshine for longer, which is better for solar PV generation. So, there is some positivity in that respect, but very likely that, again, you're going to see very, very negative impact on your small businesses. Very possible that your restaurants and hotels continue, say, doing well, but at the expense of your non-durable goods expenditure, as people, are trying to make a plan because they can't make dinner at home. So it's going to continue to be a problem. That said, as much as I'm being kind of quite downbeat on this, I do feel that we are hearing continuous small steps in the right direction with regards to dealing with the electricity crisis in South Africa. And that also might buoy sentiment enough that businesses might be willing to start investing more broadly than just for alternative energy supply.
Siobhan Redford is a macroeconomist with the Rand Merchant Bank, talking to us about the latest data from Business Confidence Index by Rand Merchant Bank and the Bureau for Economic Research. Thank you very much for your time.